Now, in this month's report, I discussed how I was considering this structure to be an expanded flat and had given out targets for wave B on the upside. And my expectation was that wave B would most probably not go beyond the 123% range simply because we closed down for the month. So it looked like the structure was uh, complete. The 123% mark was at around 9690 to 9680, and we've now closed above that range, not on the monthly degree, but at least on the weekly charts, and we are getting closer to the next point where wave B completes around 138%, which is closer to the 10,000 mark on Nifty. So while this has not been exactly a broad-based move in terms of stocks, the Nifty's got into the point where it actually, let's see, may or may not hit the 5-digit mark. At least it's on everyone's mind and mouth that it's coming, it's coming. So let's look at the structure, and I'm going to look at the hourly structure where it does show the potential possibility of that happening. So there are two triangles on this chart that I discussed. First one was this, so which is where I was thinking if the fifth wave ended, it should have ended at 9700 here, so which is close to the 9680 mark. But during the week, within a week itself, we've broken past this range. We formed another triangle here close to 9800. And that triangle essentially, so if I take both the triangles to be fourth waves, one over here and one over here, then the count would change slightly from what I have been showing. I have been showing that we have probably completed 3 and 4 into this triangle range, which is ideal because this is looking like a 5-wave rise here. So if this is 1 2, this should be 3 4, this should be 5, then we would most probably have completed. uh, but there are some indications that maybe we'll gap and open higher than even yesterday's high, and if that happens, so if I just go by taking these triangles as uh, both are fourth waves of lower degree, then actually the first wave and third wave end up looking like they're equal in size. And if I take that, no, we are developing a fifth and it's equal in size, then it would probably point towards 10,100. But if I just look at this rising channel, which is what is supporting most of this recent price move, then the upper end of the channel is close to around, again, just 10,000 odd. Now, the channel that I have been paying attention to in the trendline chart that I publish every day on Nifty Daily is taking it right from the bottom and then extending it, which therefore puts us at the upper end of the channel. So ideally, if this was the first wave here, we pulled back to the lower end. Now we are at the upper end. We haven't had a fourth wave pull back to the lower end, and we are about to if we are about to start another move up, then essentially it means you have to redraw this channel from point 1 to point 3. So if we go past yesterday's high of 9913, it would essentially involve redrawing of this channel and then expecting that the upper end of this channel would be achieved, which is then closer to the 10,000 mark and a little stretch above that. Depending on how long it goes there, and like I said, if it achieves equality, then it's 10,100. Otherwise, it's closer to 10,000 purely on redrawing these channels for price. And all this with some of the data remaining absolutely the same, which means you still have further Nifty futures unwinding when it comes to the futures position of FIs and the client side, which is short and still unwinding. Of course, yesterday being a flat day on the option side, we didn't see a further jump in the put open interest. So the options indicator just short of this line on the FII side. But when I look at the uh, client option position, which is already at an extreme of 34%, 36%, just pulled back to around 34%. Sorry, 40. It had hit 43.83, and it just pulled back to around 42.75 as of yesterday. So not much big of a change. Still an extreme. The 36,000 odd crores of net put OI that I showed the other day just pulled back to 27,000 760, and the put call ratio from 1.36 almost is at 1.29. So those indicators pulled back a bit yesterday, so we'll see how they do on Monday, but they're all still in extreme territory as the index continues higher. In fact, one of the longer term indicators that I cover every time in the long short report, and just look over it. Historically, whenever we've seen a non-confirmation, this is the mid-cap relative strength with the Nifty. So many times the relative strength really rolls over much ahead of a major market sell-off, simply because the Nifty starts moving up fast, trying to catch up with the mid-caps, and at that point of time it develops a divergence, which is something we saw in 2006 before the April 2000, May 2006 big sell-off that we'd seen, almost a 30% sell-off. Already had a divergence in the indicator. Similar pattern was there the 2010 top in the index when peaked for the rest of the year, and we hadn't seen such a divergence initially in the early moves of 2015-16. The indicator was at a high. There was some divergence here, and then it took it out and made a still higher high. So we were in extreme territory already. And then again this year's new high, what we are seeing here since May, when the mid caps actually reacted from some sentiment extremes. The Nifty is actually picked up in the last 1 month, and so the RS is actually again diverging from the market itself, not confirming the new highs. So, which is again an indication, that we're at the fag end of this move. Similar deviation also between the Sensex and BSE 200 ratio, where the key indices are now moving up faster than the secondary indices. So if you're seeing this stretch going on, in the index, and we're getting close to, on an arithmetic scale, the upper edge of this parallel channel line, which is again at the same levels. Why really keep warning about the possible reversal in trend? Well, everybody's got this number. It's 10,300 to 10,500. People come and post it on Facebook. The numbers become widely spread because everybody's probably looking at these charts and these equality numbers in different ways, drawing lines from various places, and it's almost become a consensus. And typically, consensus is something that either doesn't get achieved or gets exceeded, and so it would be a feat to see a number which is so widely expected, just come and be gone. So that is one part of it, and the other is that when I compare it to the Y2K period, which I often do, especially for the 2015 high, because that time that peak happened and then the rest was done. And I thought that's what would happen, but we still have this expanded flat higher high happening, which is what I think it is, in a completely different count to what everyone else is taking for the Nifty. Everyone's marking this as 1 2 and 1 2, and I explained in my last video cast to think about the alternate situation. And the thing that I'm finding missing at these new highs when we compare it to 2000 is that in the last quarter of 2000, when you actually go back and look at that period, and let me do that for a moment, switching to a log scale and go right back to 2000. I'm talking of this last month, Jan and Feb, this last run up, and I'll show you what the daily chart looked like. You had every day, looking at the Nasdaq, the Nifty would open gap up, sell off, gap up, sell off. In fact, the Sensex, which had fewer tech stocks in it then, and they were introduced later, actually had many of these. Look at this entire phase through January and through February, gap up, down, gap up, down, gap up, down. It would open 200 points up, sell off for the rest of the day, simply because the index stocks were not the ones that were running up. It was the K10 stocks or only the tech stocks, and the gains were quite significant, which is the thing missing from today. And what I mean by significant is, say, if I had an R cap, it went from 90 rupees here to around 300 rupees here. Using something like a trailing parabolic, it stopped out only at 290 in the first week of March. So I clearly remember that as a trade. And among others, which were happening, were like Wipro, which was the main tech stock, when those stocks were going up, circuit up, which was an 8% circuit. And within a month or so, the stock actually doubled and hit 10,000 through those circuits. So When you talk about Nifty 10,000 and you look at this one-sided rally that you've seen in the Sensex over the last month, and last few days you're seeing these gap ups, and then market sells off or holds there and then again gapping up, and there's a sign that it will gap up again based on the SGX. Then what you're not seeing is those kind of gains in any major large cap or major liquid stock. There may be some gains in some side counters. There may be stocks that are trading 5,000 shares a day and making big gains, but not the stocks that are trading say a million, 2 million, 3 million, 5 million shares a day, or a large cap really making that kind of progress through this major run. So that gives me a feeling that this bull run essentially is one of the weakest, that I've seen, and it's been the case throughout this phase that we've seen significant weakness in the breadth and in the participation, even as the indices have moved higher, and that even as we get close to the 10K mark, continues to be the case. This has also been one of the slowest advances in the market historically, which we can see in the momentum and the angle of the rise. But simply think of it that every bull run that we've seen historically at least meant that when you say it's a bull market, it's probably doubled, and that's just history. History prior to this, when you say the Y2K bubble started in 1998, went up to 2000, and actually it's much less than 2 years, and in this period the index actually doubled from year to year. When 2003 the market took off, you went from 900 something to almost 1900, doubling in a little more than 6 months, or rather less than 6 months. And then again 2004 to 2005, a little around a little more than a year, the index again doubled from bottom to top. So you've seen it, typically double at any point of time from point to point, and you at least saw that in the recovery phase in 2009, 2010. But we haven't really seen that happen subsequently. If I say the index hit a panic low of 5100 in 2013, from where just before the Modi election was due to start. Months before that, when you had the rupee hit 69, that panic low, which is the point from where you would start this new wave. And we are now 1 year, 2 year, 3 year, and we are into the fourth year, and we're still not seeing the index actually double. So it's been the slowest advance, the narrowest move in terms of stocks, but you continue to see the index move higher and higher on a narrow list of advances.